Let's be clear. I mean, it's a tough economy to call right now. We've got cross currents. But if we actually take a step back, I think the first question we ask is the economy a going concern? And I acknowledge, tail risks have gone up. But at the end of the day, if we look at some of the data we've had this week out of the US, we've had fairly good jobs data out yesterday. We continue to see reasonable sort of expectations in terms of corporate profits, etc. And the Fed, yes, they've nudged down their expectations in terms of growth, but you're still talking about an economy that's going. And then, of course, here in Europe, I mean, what a move from Germany. So the point behind it is, I think if we take a step back and think, where are we going to be a year from now? Chances are we're probably still going to be in a better place. And that starts to inform how you think about taking risk in these markets.
Let me be devil's advocate, because what we've seen so far is the threat of tariffs. We haven't really seen the true impact. And we were even discussing this morning about the fines on China's ships. That just infiltrates if you've got China ships in a whole fleet. I mean, it spirals. So could we see a situation where the market hasn't quite been able to visualize what the tariff threat looks like for earnings, for consumer sentiment, for investment potential?
Yeah, absolutely we could. And this is why the tail risk is wider than today than it was 6 months ago, etc. The point is, though, if we actually look at the resilience of corporate balance sheets, they're still in pretty good shape. If we allow for what we think is the prevailing sort of expectation on tariffs, we can see 5, 6, 7% coming out of earnings growth this year, and then a beginning of a rebound from a newer base next year, and that's on US companies. So is it right that we've seen a reset lower, a correction in the US? Yes, it probably is. Is it over? We'd argue that there could be a little bit more chop to go before we get the tariff announcements on 1st of April. So yes, absolutely. But then let's take the other side, okay? Because number one, the market obviously is pricing forward cash flows, not what's going on today. And if we look at, there's a little interesting esoteric corner of the market, the dividend futures market. And dividend futures, what people are prepared to pay to take a position on this full year's dividends, hasn't moved, even though the S&P 500 is down 10%. What it tells you, this is a re-rating or a de-rating because people are uncertain. It's not a fundamental change to the expectations of corporations. And that's a really important data point right now.
It's fascinating you bring up this point about where the corporates stand, because we've seen a similar sort of divergence in soft data versus hard data, and we haven't seen a lot of the weakness show up in hard macro data yet. A lot of the concern comes from the soft data, confidence surveys. What does that tell you about how quickly we could see a rebound in consumer confidence, that it's not actually a matter of what's happened, it's just concern about what could happen?
Well, confidence is an incredibly important channel because if you get too much caution and corporates don't spend or invest, then obviously the economy grinds to a halt. But at the same time, you're right. If we look at something like the NFIB small business survey, CapEx intentions, the level of it is at the same point we saw back through COVID. It would take a modest change in terms of tone and a little bit more clarity around what tariffs are going to do to get quite a strong rebound there. And remember, the new administration in the US had an agenda around immigration and tariffs, also around tax cuts and around deregulation. They've led off on immigration and tariffs, the bit the market doesn't like. But waiting in the wings, we still feel convinced that there will be news flow on fiscal boost and on deregulation, which potentially could give a latter half of the year boost to risk assets.
It's easy to forget.